You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is multifamily investor and good friend, Tim Bratz. Now, Tim began his career more than a decade ago in the competitive New York City real estate market, working as a broker leasing ground floor retail units. Here, Tim saw the true potential of real estate to transform lives and create massive wealth. Although Tim was limited in his means at that time, he spent his time reading, attending workshops, and networking with accomplished entrepreneurs, learning that being resourceful was the ultimate path to becoming successful. Now, in 2008, shortly after the real estate bubble popped, Tim quickly adapted and, using a credit card, increased his limit and then wrote himself a balanced transfer check to acquire the cheapest property he could find. Armed with his personal investment and plenty of sweat equity, Tim transformed a rundown duplex and turned a profit on his very first deal. He then took those proceeds and reinvested them while seeking private capital to expand his growing portfolio. Today, he and his team have amassed an impressive multifamily portfolio consisting of more than 3,000 units across multiple different markets. And so in this interview, guys, Tim and I are going to cover a litany of important topics, including how he and his team have adapted during these uncertain times that we find ourselves in today. But not only that, we also go into great detail on where we both see the best opportunities here over the coming 12 to 18 months, as well as how to best prepare yourself for when this time arrives. And so with that, guys, I'm super excited to get onto the show with Tim. But before we do, I just have a few quick housekeeping items. First and foremost, I've mentioned a few different times now, as you guys are aware, we are in the mobile home park space. That is our core focus. However, we have been studying kind of behind the scenes an asset class that we're incredibly excited about and are actively looking to start buying in here very shortly. And that is the parking lot space. So parking lots and parking garages. And we just got done writing an ebook on the topic as to the top 10 reasons why we feel parking investments generate massive cash flow and create legacy wealth. And if you'd like to grab a copy of that book, which is called Parking Lot Profits, you can simply go to our website and download a free copy. It's parkinglotprofits.com. Again, that's parkinglotprofits.com. Or you can simply text the word parking lot to 31996. Again, text the word parking lot to 31996 and grab your free copy. And so moving on here, guys, just one last thing I want to mention. We're currently in acquisition mode, not just parking lots. We actively are seeking parking lots to purchase, but also mobile home parks, which is has been our core focus for nearly a decade. And so we've made it quite easy for folks like yourself that are out there looking around that might stumble across that great opportunity to make a huge finder's fee, upwards of $200,000 finder's fee, okay? Not joking around here. We are very open to paying very large finder's fees for the right opportunities. And so to make that easy for you, we've simply put together a dedicated website that will allow you to, number one, download our acquisition criteria as it pertains to mobile home parks and parking lots, but also submit an opportunity for us to review. And so if you want to check that out, just go to the website, bringkevinadeal.com. Again, that's bringkevinadeal.com. And you can, again, understand exactly what it is we're looking for so that should you come across it out there while you're on your hunt, you have the opportunity of potentially flipping it to us and walking away with a big fat six-figure finder's fee. Okay, guys? And so with that, guys, without further ado, let's get on to the part of the show that you've been waiting for, which is our interview with Tim Bratz. So here we go. Alrighty, guys, it is my honor to introduce my guest for today's show, multifamily investor and founder and CEO of Legacy Wealth Holdings, Tim Bratz. And for those that don't know, actually had Tim on. It's been a while. It's like episode 199. It's about a year and a half ago. And so I thought it'd be good to bring him back on and catch up. He's had a lot going on, lots of big moves in his business over the last year and a half. And so we brought him back here, and we're going to get the skinny on what's new with Tim. So, buddy, how you doing, man?
Dude, Kevin, excited to be here, man. Thanks again for having me.
Yeah. Looking forward to having you back here and just again diving into your world. And you've been out there hustling, moving fast, making lots of big things happen. And so I know that a year and a half ago, I'm sure that there's been some major changes in your business. And so why don't we start there? I think that's a good foundation to lay here. And so a year and a half ago, I know it's a long freaking time, especially when you're making deals happen. So you might not know exactly what your business looked like then, but just generally speaking, from a high level point of view, what are some of the big shifts that that you've made within your business over that period of time?
Yeah, man, I think that's a great question. So again, before I even get into it, thank you again for having me. I love all the content and all the value that you provide, and have a ton of respect for you. So appreciate you having me here, man. So yeah, I would say about a year and a half ago, I was around 1,500 units. Today I'm at 3,900, almost 4,000. So picked up a lot of property in a year and a half. And we had a good foundation. We have a really good fundamental business buying structure and how we structure things with our investors and all that. And so we worked through all the kinks in that on the first 1,500 units. So it allowed us to really grow and scale pretty quickly, because it just it was rinse and repeat. Just do the same thing over and over again. And I think a lot of people actually get derailed in business because, dude, the hardest part is the takeoff, right? Like an airplane on a 2-hour flight uses up 50% of the fuel in the first 15 minutes. And so when you think about that, that's kind of like business too. Like we used up a lot of the fuel, and then once you're up top, you're just coasting along. You got to fuel a little bit, but you took out all the hard parts done, right? And a lot of people quit during the takeoff. They go and start some other business or get into some other industry, and they're in takeoff mode their entire life, man. That's not good. So we already went through that whole phase, and we were, went through getting kicked in the teeth over and over and over again, and worked through all those different kinks in our business, and really had a good system. So then we were poised to take advantage of a lot of awesome opportunity. And so that's really what we've been doing. All of last year, we were in acquisition mode. We bought a lot of stuff last year. And then this year, we bought a couple things, but it's been a little bit slower, obviously, because of the whole COVID-19 craziness. And then and just kind of refining, right? Like what got you there isn't going to get you to the next level. What got you here isn't going to get you to that next level. And so although we have good systems in place, now we're refining it even more. Like we're getting new CRMs for our investor management. We're doing a few new techniques on how to find more bigger off-market type deals. We're having some conversations with a few larger lenders, and we've never brought on any sort of institutional money before. So we're considering doing that. I really don't like it, but we're considering, and we're also considering having an open-ended fund. We've never had an open-ended fund either. So we're doing a lot of different things in that regard. Refining the education business. I do some education on the apartments, just like you guys do on the mobile homes. And so, a lot of those things have been changed, not only as you progress in business, but also because of what's happened with the coronavirus and what's kind of required us to do as well. So, dude, you move, you adapt, you change. And I think the people that are stuck in their old school mentality are the ones who get just, bulldozed when stuff like this happens.
Isn't it, you make a good point there about, those that are stuck in that old mentality, but isn't it interesting to see how this pandemic has actually forced some of those folks? I mean, think about the older demographic that was working in an office that was very opposed to using a Zoom or any type of real technology, that was literally forced to do it. Now they're like, oh, this isn't that bad, right? But it was a forced shift, right? And so you have to be able to force yourself to adapt to those changes or to get uncomfortable. And a lot of people just aren't willing to put themselves purposely in an uncomfortable situation. The pandemic did that for them, at least with regards to technology and that older demographic. But in any event, you make a really relevant point there. And so, your business model is very, I would say it's very different than the typical, syndication, I guess is the best way to compare it. The normal syndication, what that structure looks like, what have you. And, the first 1,500 units, use that timing to refine that business, right? Work out the kinks, as you had said. Went from 1,500 to 3,900. That's a massive jump. And obviously, you create some efficiencies in there, and we're able to rinse and repeat, as you said. And so I want to break down or dissect what your model looks like and how it's so very different than that of a typical syndication.
Sure. So I think so traditional syndications, they're different, right? They go out and they buy typically stabilized assets or fairly stabilized assets. They put long-term debt in place right out of the gate, and they have a 5 to 10 year timeline for their investors. And their investors only get paid if the property's performing. They don't get paid if their property's not performing. And then the operator, or the loan sponsor, ends up typically taking some fees, acquisition fees, fundraising fees, fund management fees, asset management fees, and they can fee the deal to death in some scenarios. I've seen some crazy fees be taken. And my issue with the traditional is that although it's not congruent, people aren't, like the investors and the operator aren't in the same boat rowing in the same direction, right? The investor or the operator's getting paid fees no matter what is happening with the property. The investor's only getting paid if the property's performing. If it's a distressed property, the operator's only getting 25 or 30% of the equity of the deal, and the investor has 75% of the equity. And it never resonated with, I'm a residential guy. I came from residential. I never took a class. I never read a book on syndication. I just kind of structured it what I thought would be fair. And it really resonated pretty well. But the key is you got to find off-market, direct-to-seller, wholesale price deals, and they're typically value-add, like pretty heavy value-add as well. So we've taken the model and kind of flipped it on its head, and we pay the investors a fixed return regardless of the property's performance. But the timeline that the money's only invested is 12 to 24 months. So we'll go in and buy an apartment building, fix it all up, improve it like crazy. And then once it's stabilized and it's seasoned for 12 months, we can turn around and refinance it, cash out the investors. My model is based off of residential, like I said, where you got to be all into the purchase price, or all in with purchase price and renovations for 65% of that after repair value. So if a building's worth $10 million, I got to be all in for $6.5 million. And if I can get a 70% LTV loan, I can then take that loan in 18 months, cash out my investors, and cash out my short-term bridge debt, and then it allows me to hold on to the property long-term. So my investors get a fixed return, plus I give them equity in perpetuity, but it's not 75%. It might be 20 or 25%. But I also have a lot more velocity on their money as well. So they can roll into 3 deals in 5 years versus 1 deal. And we're not selling the deal in order to get them their money back. We're refinancing. So now they can build long-term wealth with us too. And, they have the same in three deals at 25% equity is the same as 1 deal at 75% equity, right?
Right.
So that's the difference from an investor standpoint of how I structure it. And I do deals, I know we were talking offline before this, of I bring in operating partners, like joint venture partners, right? And so what I found is there's a lot of people out there who, like we're in some masterminds together. We know some great residential operators that are tired of doing the transactional stuff and want to get into long-term holds and build some real wealth. And they maybe don't have the balance sheet. They maybe don't have the experience, but they have boots on the ground type resources. They can find deals and they can oversee contractors. If you do those 2 things, I could fill in a lot of the gaps for a lot of my joint venture partners. So what happened was I kind of got spoiled early on. A good buddy of mine who's got a ton of experience in a whole bunch of different facets of real estate kind of got knocked down a little bit in the last downturn, messed up his credit on 1 deal, and he couldn't sponsor loans. So I came in and I sponsored loans. I took care of some of the administrative side of things and some of the fundraising side of things. And he was just a phenomenal operator. Went to work and got these big deals done and got them stabilized and all that kind of stuff. And we came up with a spread on how we split up the equity. And so I love that model. I like it because it's scalable, right? I don't need 100% of a grape and I do all the work. I'd rather have a quarter of a watermelon and then just really focus on what I'm really good at, right? I'm really good at raising money. I got a big balance sheet so I can sponsor loans. And dude, I've been dragged through the mud on every sort of, commercial and apartment and residential deal you could possibly think of. So I understand the whole thing, but we're really good at like the administrative side and all that stuff. And the biggest bottleneck with growing, as you know, as an active operator, is like the operations side of things. Like that's always the choke point in every business. And so I thought, if it's not 100% of my team, and I had 5 different operators or 10 different operators who were all overseeing 2 or 3 deals a piece, nobody's overloaded. My team can hop on one level 10 call once a week with each one of the operators and just kind of check on KPIs and metrics and those kinds of things. And we can raise the money, a one-time thing, but still have equity in perpetuity. I can sponsor the loan one time and have equity in perpetuity, right? And so I like the idea of the scale and the business element of that. And that's one of the ways that I've been able to grow so significantly is I have a lot of different JV partners as the operator boots on the ground in all these different projects. I'm in 10 different states, but my core team is right here in Cleveland, and we're able to just hop on asset management calls, handle capital management with our investors and sponsor loans and do the fundraising from anywhere in the world. So it's allowed us to really grow. That being said, we put a lot of faith in some people. I got lucky with the first guy that I partnered with. And then the second one, not so lucky, right? Like my team had to take over the entire operation, and it was an absolute bloodbath, and we didn't have any paperwork in place. And that person got their percentage of equity, and they still have their percentage of equity, and they didn't have to do anything, right? It's like, holy. So that was one of the learning lessons over the past 18 months. But it's helped us build the business. So
yeah, no, that's great. I appreciate you going in depth there. And so I was going to ask a question about, like, you got these, 5, 6, 7, 8, 9, JV partners, boots on the ground in these different locations, right? Like the chances of having one of those go bad, right, and have it not work out gets greater and greater the more these partnerships that you create, right? And just the matter of managing those partnerships and managing those different personalities. What are some of the bigger I guess, no, let me rephrase that question. What is the vetting process, right? It all starts with the vetting process to determine, forget about the deal, right? Like there's always going to be deals, right? But you want to make sure that you're going to get in the right marriage, because that partnership ultimately is a marriage and it's going to last quite a long time. You surely don't want to get in bed with the wrong individual. And so what does the vetting process look like on the front side? I know that nothing's foolproof, but what does it look like on your end to ensure that you're doing everything in your power to align yourself with the correct boots on the ground partnership? Yeah,
great question. And we've gone through a lot of learning lessons on this over the past 18 months. So early on, it was anybody who brought a deal. Like we just wanted to do deals, right? And so anybody who brought the deal, if they wanted to be the project manager on that, we would just let them, and we give them a certain percentage of equity for that. We quickly found out that some people are not qualified project managers. And so one of the big things is they got to come out and be educated, right? Like, so I do a coaching thing and make sure that people understand the philosophy and the mindset of what the process looks like. Then they have to be interviewed by my COO and make sure that everything jives with them. They understand the mindset and all that kind of stuff. They have to be experienced. I'm not going to, if you've never flipped a house before, I can't give you a 200-unit apartment building and go and flip, right? And oversee the renovations on it. It's just not going to happen. I have a fiduciary duty to my investors that I got to put the right people in place. So that being said, though, there's a lot of people who are great operating on the residential side, but they're not. They haven't done it, on the commercial side. Like we know guys who flip 300 houses a year, and they obviously understand systems and processes and mechanics of it. But maybe they've never done it with an apartment. So that's where we kind of come in as a consultant, as a coach, as a mentor. And that's why we we get on a phone call every single week, going through all the KPIs, very clear expectations on the front end of how do we keep this thing on price and on time. And so, what we do is we help out with all the due diligence, and it's almost like a mentorship throughout the whole process. We are still very involved, but we see it as a long-term investment, right? It's investing in this awesome operator, because you can teach the mechanics and the science behind it. What you cannot teach is some of the art, and you cannot teach, attitude. You cannot teach resourcefulness. So that's really who I'm looking for in a partner. And then we can teach all that other stuff. And the first one, we're very engaged in. The second one, we're still very engaged in. But then after that, they can kind of rip the ball out of our hands and run down the field with it themselves. And so there's definitely multiple layers. My team is a layer. We do have third-party property management as a layer, and then there's the boots on the ground. So, and then we have on-site property managers and maintenance staff and all that kind of stuff. So even if somebody doesn't do what they're supposed to be doing, there's multiple layers in place where somebody can kind of take a little bit of the weight off until we get that other position filled. So that's a big one. And then the other thing that we've implemented, which we haven't had to put it in force yet, but I just wanted it because I wanted to hang over the operating partner's head, is we say, hey, Kevin, dude, you're going to be the operating partner on this. I'm excited to be working with you. How long is it going to take to renovate this whole thing? It's going to take me 6 months. Awesome. Here's what we're going to do. I'm going to give you 18 months to get this thing to the finish line. Does that seem reasonable? Yeah, I can absolutely get it done. Great. If you don't get this thing to the finish line in 18 months, Kevin, I need you to sign it. I need you to sign a unit member transfer agreement for your equity in this deal. And now there's different thresholds: 6 months, 12 months, 18 months. Because if you don't get this done in 18 months, then guess what? Our investors aren't getting the returns that we projected for them. my team now has to step in and do a boatload more work that we haven't been compensated for, right? And so I got to be able to take some equity away from you and give it to the investors and give it to my team in order to then pick up all the pieces from you dropping the ball on this thing. And so we have certain thresholds in place where they have to meet it. And if they don't sign that unit member transfer agreement on the front end, then we will not do a deal with them.
Yeah. I mean, that alone is a perfect vetting solution. I mean, seriously, I mean, like either anyway, that's wonderful. I love that, man. Have you actually implemented that in your business yet, or is that something?
No, we haven't had to yet.
Okay.
We haven't had to yet. I mean, it's not my goal to do it, right? It's not my goal to have somebody do the work and then rip the equity.
But it's all about direct alignment of interest. I mean, that's really what it is. Again, this is a marriage, man. It takes a team, and if one side of that team is not doing their part or pulling their weight, then the whole shit falls apart, man. So, no, that's good stuff. I love that. I want to chat about maybe some of the challenges that you guys have had. You mentioned 10, I think you said 10 states or 10 markets. I forget which one it was, but either way. Obviously, that means probably a variety of different property management companies as well, right? Third-party property management companies. You might have a few crossovers here where one management company manages a couple different states. But what are some of the biggest challenges you face there as well? Because again, another vetting process. Obviously, you guys have your business model requires some of a tighter timeline. You guys are getting into heavy value add projects. You guys are looking to turn these things in 2 years, do the renovations, get them seasoned so you can put some longer term agency debt in place, right? And so everyone's got to be pulling in the same direction. And if the property management company isn't doing their job, then again, the system has breaking points in it. And so how have you guys gone about finding the right ones and vetting them appropriately?
Yeah, I mean, it's not easy, right? It's almost like contractors, right? You got to go through a lot of them, and when you find a good one, you hang on to them, but at the same time, you can't give them too much because then you overload them, and then even the good contractors can, they have this with management companies too, where they implode. So what I found in commercial real estate, which is a little bit different than residential real estate, is that the management companies are typically regional, right? And they're typically in the Southeast or in the Midwest or in the Great Plains type areas. And so whenever we have properties in this certain region, we can typically lean on our existing management company to come out. I will say that up here in Cleveland, Ohio, we have our own in-house management company. So we manage everything in-house. Down in South Carolina and Georgia, and most of our stuff in the Southeast is in the same vicinity. It's with my first initial joint venture partner, and we've built out our own in-house management down there. Everything else that we have, I got some stuff in Illinois and Louisiana and Texas and Oklahoma where we use third-party management for that. And we've had really bad management companies, and we finally sourced a really good one, and we really like them. They manage over 20,000 units or something like that. So they're a big regional management company, but we make sure that they're on the phone with us because nobody's going to pay attention to your property if you're not paying attention to it. So you got to still we get them on the phone along with our local joint venture partner, the management company, and the on-site property managers. And so they're all on a phone call once a week with my COO going over KPIs. So everybody's on the same page. So although it's, everybody gets into real estate, man, because they think it's like passive income. There's a difference between residual and passive, right?
Yeah,
you still have to work.
Definitely not passive.
Right. So, we're still paying a lot of attention to it. Does it work every? No. I mean, like there was one management company who was charging us, like they sent out Christmas bonuses without asking us. I'm like, who do these bonuses go to, right? They sent out, they're charging us for mileage when the property manager, what else did they do? They were paying for their own computer and they bought their own computer on our property, and like Slim Jims, all that kind of stuff. So it's not like I don't want to have to go out and babysit that, but somebody on my team has to pay attention to that stuff, And so there was one company that was just not performing, nickel and diming us. We had to get rid of them. And that, that, like you said, it takes several months to go through that whole transition because you don't want rents not being collected, maintenance not being performed. It has to be I try to make it as seamless of a transition as possible. So we've definitely had some projects that have been extended, but that's why it's always been on smaller deals where we don't have on-site managers or something quirky like that. So that's why we're only doing bigger deals now. If we have 100 units, I can have at least one property manager, probably a leasing agent, and a couple of maintenance guys on staff. So if anybody doesn't do their job, I can at least have some of those gaps filled in somehow while we get rid of and replace whatever that position was.
Is your property management company, are they typically acting as the liaison between your GCs and your asset management team, or how do you have that structured?
Usually whoever our joint venture partner is the one who's handling the project management side of things.
Like he or she is the direct point of contact to the GC firm that's handling renovations. Okay, got it.
So what we've tried to do is, we've tried to have management company handle everything, and then what happens is they start taking the rehab crews off of the vacant units and handling maintenance with them, because we're typically buying distressed stuff, and then all of a sudden the renovations on the vacant units gets kicked down the road 6 months. And we're like, what the hell happened? Well, we needed them to do all these. So we've completely separated the two of them, where management handles occupied units and the joint venture project manager handles all the vacant units and common areas. And so we've separated it. Is it occupied or is it vacant? Talk to this person, talk to that person. And that's helped alleviate a lot of that problem.
Yeah, no, that's great to know. I want to shift here for a minute, and I want to chat about the pandemic. I think we're on again, not to be insensitive to those folks that might be listening that are in a state like, California or Los Angeles County or, Manhattan, what have you, or another market that is still in lockdown. So, we're down here in Florida. They've been lightening up a good bit over the last couple of weeks, and so is, many other states. But I feel like we're on the other side of the hump, at least, even in those other states, right? Like we're edging towards opening the economy back up and the nation back up. And so with that being said, obviously the last 2.5, 3 months have just been out of ordinary is the best way to put it. And so everyone's had to adapt. They've had to pivot and make changes within their business. Like, what are some of the biggest changes outside of communication with the residents and things of that nature? I mean, that had to happen to, initiate collections policies and, workout plans with any residents that can pay, what have you. But are there any other major changes that have shifted in your business? Like, I know in the beginning you mentioned, or maybe before we actually start recording, you mentioned, bridge lending. It's gone right now. At least it's off the table for the time being. CMBS is completely gone for the time being, right? The lending market has changed. And so I'm sure there's some shifts in your business model per se that have had to be made in order to adapt to these new times. So I'll let you take it and run with it, and just again share anything that has been a somewhat major change within your business, bud.
Yeah. So from I would say that I think there's 3 pillars to real estate investing. 1 is finding and sourcing deals. 2 is raising money, and 3 is operations. So I'll kind of go down and think of each one of them. So from a finding deal standpoint, underwriting deals, obviously we're stressing the numbers way more than we were before. And we either need to be in at a lower basis in order to still buy that deal, because now we have to use hard money instead of some sort of bridge financing. Or we're buying more stabilized type stuff, which is long-term debt right out of the gate, that we can put supplemental debt on maybe sometime in the future. But those you typically don't get as good of a deal because they're stabilized. Nobody wants to sell a stabilized asset for a discount. And then the other thing that we're doing is kind of in the middle is, if it would have met our buying criteria 90 days ago, but doesn't today, because we've gotten more conservative, we're going to the seller, and we found that the sellers, maybe they're not budging as much on price, but they're more amenable to taking terms. They're more amenable to seller financing, or like a master lease with an option, or like or taking a seller carry on the secondary, and maybe getting them to contribute the equity as the equity investor. So that way they get 80% of their money, and then they take the other 20% as equity in the deal as the equity investor. So we've come up with some really creative strategies, which is, dude, I started investing in 2009 when nobody wanted, the reason the economy fell apart was because of real estate. So nobody wanted to invest in real estate. So I had to do a lot of that stuff back in 2009. I've been spoiled over the past few years because money's been so easy to come by. But on the acquisition side, that's one of the things that we're doing. We haven't seen that prices have changed too much, maybe a little bit on a case-by-case basis, but for the most part, not really. And we just padded our numbers. We're trying to kill deals even more than we were before. And then if we really can't kill it, we know it's a good deal. Are we still buying? Yes, I'm still in acquisition mode. And I think some people are like, hey, I'm going to wait it out, or hey, I'm going to see how things play out, or I'm going to take my time and step back a little bit. Like, I don't even know what that means. I don't get it. I don't understand why people do that. I think there were good deals and bad deals a year ago. I think there's good deals and bad deals a year from now, and there's still good deals and bad deals to be had today. So we're still just looking for good deals, right? So that's on the deal side. On the money side, obviously bridge financing is non-existent. So we're doing a lot more of the creative financing stuff. From an investor standpoint, like raising private money and equity investors, I've found that some people are a little bit more standoffish, and then others are like doubling down. They want their money out of the stock market, out of some sort of volatile, jumping up and down nonstop, and into something that's fixed and predictable. And so we've had a lot of people that have fallen out of our recent deals, and we've had other people who just doubled down, like tripled down, like brought a lot more money than I thought that they had. So that's on the money side. And then from an operations standpoint, I think everybody's been just refining the hell out of their operations and being like, what do we do? Like, we've met this intense situation with just as much intensity on the operational side. And I think you have to. And so we've been very, very proactive, reaching out to tenants. We've been very proactive on making sure everything's sanitized and letting people know, and communicating with our vendors and communicating with our contractors and our team and all that kind of stuff. And so we've been just refined in that regard. So those are probably the biggest things that have been changing for us.
Yeah, that's awesome. I appreciate you sharing that. And across the 10 states that you guys are located in, were there any states that you noticed that took a harder impact, that had lower collections or more challenging collections than others? Did you notice any kind of big variances like that?
I noticed that the management company or the local leasing or like the property management blamed COVID-19 for their lack of effort. Right. And I knew that they weren't working or whatever that was. So there were certain ones where I was able to come in and just kind of slap them across the face and get them back into things. And then all of a sudden rent started getting collected. Right. Or my COO actually came in and slapped it. But I have a lot of property in Georgia, including Albany, Georgia, which was like the epicenter of the COVID outbreak in the Southeast.
Really? Really? Wow. I didn't know that. Huh.
Dude, Albany, Georgia, man, was like, there was, I don't know, one person who had coronavirus went to a funeral and gave it to like 40 people, and then it just went crazy.
Oh my gosh.
And one of my buildings down there had an outbreak. We've had, 30, 40 tenants with coronavirus. And I think 2 died.
Wow.
Elderly, yeah, crazy. And so because of that, there was a big scare amongst the tenants, amongst the local property managers, the leasing agents, the contractors. Nobody wanted to go work, maintenance staff. And so we definitely saw a lull across several of our properties in that area. Like it was very slow for probably 4 to 6 weeks. And then, dude, we've been leasing like crazy now. Everybody's like, oh, okay, everything's good. But and so they're signing up leases. We had 100 tenants placed in March, right before all this stuff hit. And then in April was really slow, but now May's rocking and rolling again. So I have seen that rents are still paid, but they were paid a lot longer and slower and over an elongated period of time in those markets. But dude, I can tell you that my stuff up here in the Midwest, where it wasn't that affected, we collected more in April than we did in March, and we collected more in May than we did in April. It was 2 of our best months we've ever had. So I don't know. I think it's a little bit market dependent, but also,
Yeah, I think a lot of that also has to do with, who the demographic is that's living in those apartments, but also state by state, who got the unemployment insurance figured out, and which other states, just fumbled it completely. New York and Florida completely did probably the worst job ever across the nation as far as like taking the application, processing it, right? No one was prepared for, no one's systems were prepared for this amount of influx of folks filing. But in any event, New York, I think they just started getting theirs like 2 weeks ago. We've got stuff up in New York, and we've got stuff here in Florida as well. And both those states were definitely much further off than our communities. And we got stuff in 13 states. So we've got a good barometer of, what the differences look like. But anyway, most of it was due to the inability to get that unemployment insurance in a timely manner, and that the measly $1,200 stimulus check they got. It just wasn't enough to really even make a dent. Given the beginning of the pandemic and just trying to survive, right? And so one last pivot here, and then we'll be respectful of your time, buddy, and let you roll here. But I want to get to the exciting part of the conversation, because this is where this is really where the rubber hits the road. And I think it's going to take some time for it to really play out. There are multiple different industries that are taking, the beating worse than others. Hospitality just absolutely getting crushed. Retail absolutely getting crushed. And it's going to be a long time coming before either one of those even remotely pull themselves out of these trenches. And so I'd love to hear from your perspective, over the next, again, let's time it out maybe 12 to 24 months as the blood really does run in streets, and not just from those two industries, just generally speaking, right? The pain will come in many different forms. What do you think some of the biggest opportunities are going to be that come out of this whole thing?
Yeah, man. I mean, that's $1 million. That's $1 billion question, $1 trillion question, right?
Come on, man. I thought you knew the answer, dude.
Yeah, I know. I wish. And here's my only issue with projecting the future is nobody knows. If you talk to an economist 90 days ago about what does 2020 look like, every single one of them would have been wrong, right? Like meteorologists are right more often than economists are. And so I think about this and think this is just kind of a crazy time. Nobody living has ever seen what's going on right now. And can we predict it? I don't know, but there's absolutely people who are hurting really, really bad. And there's going to be some sort of opportunity that comes from it for the people who are poised, to capitalize on it. So I think, and you touched on this earlier, is that there's just ideological shifts that are going to happen. There's a lot of people who didn't want change and that are going to change a lot. And I think there's going to be, I think obviously, kind of to your point before, is the older generation who didn't want to jump on Zoom calls. I think there's a generation of, or a lot of retail business owners who didn't want to get onto the e-commerce train, and they're trying to just kind of, ride out whatever is going to happen. Dude, Amazon's been putting businesses out of business anyways. This just looks like a catalyst on some of the retail front of things. So I think retail is going to be a massive shift. I think office is going to be a big shift. People are like, hey, I don't need 20 people in my office. I can probably get away with 8, right? Everybody else can work from home because we all familiar with these Zoom meetings now. And so what does that do to office space? Because retail prices drop, does all of a sudden office tenants want storefront because it's the same price as what their office is? Maybe they get some walk-in traffic. I don't know. Then what does that do to office? Maybe that turns into storage for the retails that just went off, right? Maybe it turns into self-storage facilities. I mean, there's a lot of different things that could populate. It's just, there's a lot of moving parts. I think what's going to be really interesting is, like we were talking offline, like what's going to happen with hotels? What's going to happen with hospitality? And they've been kind of feeling the effects of Airbnb and VRBO, and what's going to happen with that. I heard a statistic. I think in 2019 was the first year that Airbnb and short-term rentals revenue exceeded what hotels brought in Florida.
Wow.
Craziest stat, right?
Damn.
So they've already been feeling it. Is this a catalyst? Is this just the straw that breaks the camel's back? What happens to all those hotels and hospitality? And you were saying they're all in prime real estate locations. Do people now move into those locations, or does it get repurposed into multifamily? Depends on what the price point is. It's going to be very expensive to outfit some of those hotels. Because the reality is you're in a hotel room that's a confined space. One of the things we saw in multifamily over the past couple of years is like these micro living spaces, kind of like very European. It's 400 square feet or 300 square feet. And it's more about the amenities and hanging out in the common areas and the rooftops. And dude, I think that's gone, right? Like nobody wants to go and hang out with a bunch of other people in that type of close-knit community and have that many people breathing in the same ventilation ducts and stuff, because you see what's going on in New York right now. So I don't know. Are they going to want to move into a hotel and only have a 300 square foot space? Or do you have to knock out a whole bunch of walls and make it 2,000 square feet? I don't know. Like there's a lot of moving parts. And so it's hard to speculate, I guess is what my point is.
Yep.
And what I will say is you just take every day at a time, and you make the best decisions, best investment decisions as that you can based on the information that you have and the experience that you have. And I think if you have good, sound fundamentals like you do, buying at discounted prices, creating appreciation through value add, buying for cash flow, buying in solid like workforce type housings is typically what we buy in. You got good financing terms that are friendly to you. Non-recourse loans, long-term amortization schedules, and long-term, like not any balloons in a short-term period, fixed interest rates. Right, you're doing a lot of stuff like that. I think that mitigates a lot of the risk that could come from the uncertainties that are down the road.
Yeah, no, I agree with all that. And when you find that crystal ball or that the magic ball, man, let me know. Let me borrow it just for a day or two, right?
Yeah, man, good for sure. But I think there's going to be opportunity though. We all know that.
Yeah, I agree. One of the interesting things you mentioned the hotels and the potential conversion. There could be an opportunity there. And I had a conversation. It's been about a month now, maybe a little bit longer. I think we were probably towards the tail end of April, about a month ago, with the CEO of Hotel Equity. So they're one of the larger hotel operators and owners in the country. And one of the bigger items I had not even thought of during that conversation with him is, forget the hotel rooms, right? Like you talk about large hotels that have banquet space, and like one of their significant line items of revenue is renting space, right? And doing events and catering and all that. Like, when's that going to come back? Is it going to come back? If not, what do you do with all that extra space that's attached to the hotel, right? Yeah. I mean, you can't do a wedding in 6 times the amount of space for the same amount of people, and that doesn't work. So, just lots of. It'll be interesting to see what behavioral shifts really come out of this. Which ones stick, and which ones don't. I want to follow him, but Jason Hartman's a good friend, and I listen to a lot of his stuff. And, one of the things he's pushing towards is that, there would be a massive exodus of, densely populated urban locales, Manhattan, Chicago, downtown areas, right? These areas where everyone's kind of living on top of each other. I think to a certain extent, I think that will happen in short order, just because people have been literally stuck inside their houses for the last 2.5 months, and it's cold environment in New York, can't go outside. If they did, it's freezing anyway, right? It's gray, depressing. They're looking to get the hell out and go somewhere sunny and warm, at least for a short period of time. Maybe not truly move forever, but, so I don't know what the long-term effects look like there. Those real behavioral changes, if it really does have an impact, and see a resurgence of suburbia, which, kind of happened back in the 80s and 90s, 70s, 80s, and 90s, and then now it's kind of shifted back over the last decade to, living in a densely populated urban environment. So anyway, again, I guess what I'm going with is the same thing you're saying is like, it's just going to take some time to kind of watch and wait and see what happens. But even then, there's still opportunity, right? Like you and I were talking about, the interest rates. I got a rate sheet last week from Fannie, and sub 3%, which is absolutely ridiculous. And only 15 basis points to add 10 years of interest only. That's ludicrous. That is a once in a lifetime opportunity. That itself is a once in a lifetime opportunity. Mm-hmm. So
you use that to price it into the deals, right? You get very competitive in buying deals and getting sellers pretty close to the price point because you got free money. Dude, every month you make a mortgage payment, you're taking money out of your right-hand pocket, putting in your left-hand pocket, you know?
Yep.
And so, you work with the different varying factors and just realize since the beginning of time, it's always been opportunity mixed with struggle. Doesn't matter, right? Like 3 months ago, 6 months ago, the struggle was there's no deals, right? And now all of a sudden, the struggle is what's going to happen with retail, what's going to happen with hospitality, nobody knows, but dude, if you're poised, like there's going to be billionaires and trillionaires made potentially out of this whole downturn.
I agree. Well, brother, it's always a pleasure getting together with you, man. I'm glad to hear that you're just absolutely kicking ass and making things happen still. And we'll look forward to keeping in touch. And, for folks that want to learn more about you, buddy, and what you got going on, what's the best place to reach in and learn more about your company and just getting all the projects you guys have working?
Yeah, man, I appreciate that. Just connect with me on social media. I'm very active on Facebook and Instagram. So just shoot me a message if you want to talk, you got a question and just want to connect. Just shoot me a friend request and then shoot me a message. Would love to help out any way that I can.
Awesome, buddy. Thank you again, man. And let's stay in touch and good luck to you over the next couple of months. And I hope that property in Albany, Georgia, I'm hoping that's all back to normal now. So yeah, that's crazy.
It's good.
Anyway, but thanks again, Tim. Appreciate it. And guys, thank you for tuning into this week's show. And until we meet again next week, this is your host, Kevin Buff, wishing you huge success. You guys take care now.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.